Hello and welcome to another edition of the Goldman Guide. I trust everyone is enjoying an extended weekend. We've had some decent weather, so I can't complain. Now that much of the fourth quarter season is over earnings wise, we have an absolutely huge amount of data and information that we had to review. Still, the most important news is, well, actually, news from late last week. So today we're going to review this all important news, provide some key information, and prepare you and your portfolio with what lies ahead, in addition to planting an interesting seed in the form of an unusual consideration coming from an equities guy. So without further ado, here we go in just a few short minutes. About a month ago, I noted how it seemed like the stock market was behaving like it was the January effect again, when retail investors really helped drive stocks, especially small ones. Remember that? Or those that took a massive tumble the calendar year before? Well, when news from CNBC and other outlets last week noted that in the month of January, retail investors poured in $1.5 billion a day into the market, that answered the question that was plaguing me for weeks. Why were stocks performing so well across the board? It may have also played an early role in the crypto resurgence, by the way, so I thank you for that too. I wish it could continue, but oh well. Now look, there's a reason why the AAII Investor Sentiment Survey is used as a corollary for the market. There's an historical inverse relationship between retail investors' sentiment and actions and their investment performance. But I have to say, it gives me more confidence that our call last week saying that the market is on its way down now was on point. Even JP Morgan put out a note last week saying the same thing, as did others when discussing future economic trends. Fact remains that the better the economic performance, that usually translates into higher inflation and more or greater interest rate increases, and that's bad for equities. And just to be clear, because we expect that the market is embarking on a negative swoon doesn't mean that opportunities do not exist. They do. Now we, and I mean all of us, have to be just more discerning. Utilize stop losses, monitor events, the economy, and the peer group trends of our favorites much more closely. As you can see here, from all of this data, there isn't much to say valuation or trading wise, except for the fact that stocks kept a neutral RSI status, and that really indicates that no one has any real conviction in either direction right now. And yet somehow, the four major indices are up an average of 7.9%, and Bitcoin somehow is up almost 50% year to date. Amazing. Now, for the third consecutive week, ETF data is the most interesting of them all. On the outflow side, two of the top three ETFs sold were investment grade and high yield corporate debt. The second one, it was SPDR, SPY, the S&P 500 ETF, and over 2 billion of it. On the inflow side, number one was the Vanguard S&P 500 ETF, a sister, if you will, or certainly a comparable. And this transaction, or these transactions combined, do seem like an anomaly for it to be the number one, as it usually doesn't get this much action. Surprisingly, short-term debt ETFs were also in acquisition mode. So I wonder, what does this tell us? First of all, for those of you who don't follow the bond market, and many of us don't, we're currently in an inverse pattern, and have been for some time. Short-term treasury yields are higher than long-term treasuries. And this pattern is usually followed by or in conjunction with a down or bear market. Now, it usually signifies that debt investors foresee more inflation and higher rates. This is in contrast with comments from the Fed, which have indicated that they're only going to have a couple more rate rises and small ones at that. However, the market is telling us something different, and that it may not be happening right now. The annual inflation rate, by the way, has been in a monthly decline for months since peaking last year, and we're at about 6.2, 6.4% right now, and in March we'll get the latest data. So as I sit here, I wonder, if I was worried about stock values dropping, and I am, is it better to put more money than I normally might in one-year treasuries? I mean, the damn things are yielding 5%. Now, I realize inflation eats into it, but boy, that's compelling. Even though my gut tells me and my experience tells me, yeah, buy growth stocks that can beat inflation. I don't know. This is really tempting. Just food for thought. Anyway, since we're mainly here focused on stocks, I thought I'd share an interesting tidbit from your Ardeni research. As of 2/15/23, just last week, over 400 of the 500 companies in the S&P 500 index reported fourth quarter 22 results. And what happened? Well, this group provided the fewest upside surprises and most negative surprises in the last 10 quarters on a percentage basis. Maybe that changes when the full group reports. I don't know. I think this is more likely the trend. And the last time we reached this pinnacle was over 7 years ago. Stocks were flat for several months and then had a strong end of year, which is what we think is going to happen this year. Speaking of earnings, next couple of weeks we'll see a lot of retail firms reporting, and they end their year in January rather than December, which is why they lag behind. Now I've got 10 key points or themes for you to be aware of with this group. All important stuff, by the way, of course. Now, the consumer discretionary or cyclical category, which includes retail, has been one of the best performing industries in the entire market year to date, which is a bit odd considering the overall economic issues. I think that retail investors have been buying retail stocks though too. So if a sell-off does occur after earnings, sell-off might even be extended, right? Now, retail companies begin to report in earnest this week. And it'd be interesting to see how the market reacts to the segment leaders like Home Depot, ticker symbol HD, Cheesecake Factory, ticker symbol CAKE. Both these are leaders in their spaces. Many other companies report as well. Most important in my mind is Home Depot. It's such an important bellwether for home builders and those fixing their homes up for remodeling, buying appliances. So if Home Depot doesn't do well, or forecasts numbers that are below current estimates, that might hurt the market. Now, my understanding is that in some stores, sales have been a little bit light recently, and many stores have had problems with theft, so we should watch it closely. By the way, on the consumer discretionary group valuation side, the multiple currently on 12-month forward EPS is 24.8 times. And a bunch of stocks have already run this year. And this, of course, includes the retail segment. So I wonder if it already is fairly valued. And even if the numbers are good, will it be enough to extend the rally? Or will we see just some profit taking? I don't know. If you're concerned, you might consider selling some calls on partial positions. By the way, how's this for a kick in the butt? The footwear space has a 12-month forward PE that's nearly 3 times higher than the one afforded the apparel and accessories segment, 32 times versus 12 times. How can that be? Why is that the case? I'd love to know. Please let me know if you have some sense of this. By the way, there may be some value in certain specialty store stocks, like sports-related small competitors to Dick's. They trade well below it, and we're watching some for later in the year since we had some winners in the past. Finally, a hometown favorite that's just so disappointing. Under Armour, ticker symbol UA. Looks like it could break down below its 200-day moving average of 842. It's currently at 931 and just seems fundamentally troubled. It had a weird new CEO hire. The street's lacking confidence in the forecasts and the model, and we hope things turn around, but we're not feeling too good about it. If you have any feelings or ideas about Under Armour, Home Depot, Cheesecake Factory, or Treasuries for that matter, please drop me a line. My email is at the bottom of the newsletter and, of course, on the website. I welcome your thoughts. Now remember, nothing we discussed today is a recommendation to buy or sell. They are all discussed for informational purposes only. And that will do it for this week. Thanks for listening, and we hope you have a great week.